Hey there, how you doing? Welcome back to the channel. So today I wanted to go over this civic science report. It's actually a survey. It was done recently. It's 2,676 responses done on March 23rd and 24th. So this is kind of interesting here. More than 75% of U.S. adults express concern about inflation. Interesting. So let's see, how concerned are you right now about inflation in the US? Not sure, 6%. Very concerned and somewhat concerned is 42 and 35%. So here's where we get you 77% are concerned. Wow, that's a lot of people concerned about inflation. That is a lot. So let's go over here and see by age group. So what's really interesting here, and I'm really surprised, is by age. So but for 18 to 24-year-olds, we have 52% are very concerned, the most out of any group. And then add that with the somewhat concerned, you have 70, 80% are somewhat or very concerned about inflation in that young group. That's surprising. Yeah, because they're young and I don't know why, like all these people are living at home. Like, what do they care about inflation? That's very interesting. Maybe that's a positive sign for the future. Maybe they're waking up and paying attention to things, but we'll see. Now, the next group, 25 to 34, which I assume is people that are like out of college and maybe working. I have some nieces and uncles that are, probably in that age group. So they're out there working and stuff. So they would be more concerned, potentially. So we have 81% altogether, somewhat concerned. So that makes more sense. They're working, so they are buying stuff, and so they understand when prices are going up or sizing's going down. And then 35 to 54 people should be very concerned, and but altogether they're similar amounts. Actually, this group is 36 plus 48, 70, so it's 84%. So that's the largest somewhat an overall concerned group. That makes sense because these people are working. And then on the older side, if you're in that age group and you're working, you got to be thinking about retirement. So you got to be concerned about that because, you just do the numbers. You're like, you go try to figure out what you need to retirement. And it's like over $1 million or $2 million. And then you're like, oh my gosh. And even though the market's doing well, you're still like, oh my gosh, how do you sock away that much money? It's not easy. And then to the 55 plus, this is weird. So this is the group that's less concerned, it seems, than anyone else. And especially the very concerned are only 37%. So that I don't understand. If you're 55 plus, you're probably, and you're working, you're probably, you're really thinking about retirement, and you should be the most concerned about inflation because you're in the position where you have to, actually, you're going to stop earning income and you're going to be in a fixed income and you're going to have to live off the meager social security or whatever. So this is interesting. So this is something that I would think the Fed would be shocked about this, and this may wake up the Fed because this is a very big concern because this has to do with velocity of money, and it has to do with the thing that the Fed cannot control, which is velocity of money. Okay, so what is that? So here we have this GDP equation here. And we have M stands for money. So it's really the money supply, typically the M2 money supply. Then V is the velocity of money, or it's the rate people spend money. So if I spend $1, you could view that as velocity 1. If I spend so let's see, if I spend $1 and that person just puts the dollar in the bank, that would be a velocity of 1. If I spend $1 and then that person that gets the dollar spends it, that would be a velocity of 2. And then if, that person spends it, it'd be velocity of 3. So it's just the amount of people buying and selling stuff. So how often those dollars are changing hand. You can imagine in different economies and different things. If people are saving, the velocity is low. If people are out there partying and spending, the velocity is very high. So that's the way to view that. And then P is the general price level. So this is your inflation. So this is what you're talking about if you're looking at the CPI, or there's all these different measures, but this is generally your inflation. It's the overall price level. And Q is the quantity of goods. And this is really GDP. This is your economic output. So this is the GDP. So the thing that happens is they can measure these different things. What they can do is they can measure GDP you can disagree with how they measure it, whatever, but they have a methodology for measuring the quantity of goods and GDP, and they measure. And then the price level, this is your consumer price inflation, measured different ways, but they have a methodology. You can agree or disagree. They have a methodology. And then the money, they have a way of measuring the money supply that they can measure. But what they can't measure is V. So what is V? Velocity, this is the way I view it, and it's not maybe perfectly strict interpretation, but what it really is it's a fudge factor. So take V out, make V 1. So if you make V 1, then M equals P Q. So with M taken out of there, your money supply is equal to the product of the price times the quantity. Okay, that makes sense, right? So if I have 100 widgets out there times $100 a widget, that's the amount of money that I have out there, right? So you can see that the equation adds up, right? But the problem is that if you take M, which is the money supply, and you add, like we've done recently, to the money supply, you add $2 trillion to the money supply, but prices don't go up. In the quantity of goods, the GDP doesn't improve. Well, what's going on? The equation doesn't balance, right? It just doesn't balance. Well, wait, I put $1 trillion in, and none of these things changed the GDP. I'm still in recession, and the prices, well, I'm not measuring any price increase. So what happens? It doesn't add up. So then what you can do is just put a fudge factor called velocity. So even though velocity, we have this intuition that it's like, okay, people spending money. So I mean, it could be viewed as a real thing, but in this kind of argument, it's sort of acting like a fudge factor. And what's interesting here is normally the way you just solve for velocity is this price time, your GDP price times the quantity over the money supply. And it's usually kind of solved that way. So the thing is, let's look at what's been going on with the money, the velocity of money. So here we have the velocity of the M2 stock, and we can go out, this chart will go all the way out. St. Louis Fed, very good place for all these charts. Like there's I think it's 12 Fed banks, and they all have like a president, whatever, that reports into the Federal Reserve Board, and then you have they do all that heavy duty stuff. But you have these reserve banks, and this St. Louis Fed is known for their data. That's their specialty, collecting all this data. So it's worth it for you to just kind of look at Fed economic data, look at all the charts. They have a lot of good data here. So this is the velocity of the M2 money stock. So what you can see here is that it was kind of flat for many years in the 60s, 70s, 80s, and then it increased in the 90s, and then it's been declining ever since. Ever since like 90s, 2000, it's been decreasing. Here we are in 2020, it's been decreasing. So, why is that? Well, we can speculate a little bit about it. We know that we had the tech crash in 2000, right? And what was the response? Basically, the Federal Reserve has always come out and tried to smooth over these recessions and smooth over the stock market, bond market dislocations and crashes. And they always do it by like printing reserves and trying to go out there and buy treasuries or buy mortgage-backed securities. And in essence, what they're doing, and I know the mechanisms can be complicated, but they're essentially printing money. They're increasing the money stock. Now, there's the transmission mechanism. Normally, they need to go through the banks, et cetera. They pile the reserves on the banks, and then the banks, they hope they go take and lend it out to the real economy. But in general, it's an effect that the M2 money supply increases. So if we look at the M2 money stock since 2000, what's been going on? It's been going up. It's going up. So what's really going on here is, so now I'm going to zoom out to the 80s. The money stock has just been increasing this whole time. So what's going on is, this is your intuition. We've always been increasing the money supply, right? That's just the nature thing. That's why we have generally inflation, because they just constantly increasing the money supply, but it's kind of more at a stable kind of pace. But then recently what happened here, like after the cerveza sickness, we just increased the money supply, just huge ramp up. But what happened over here, the money supply, when they did that, it just dropped off a cliff. Well, why did the money velocity drop off a cliff when the money supply zoomed up? Well, if we go back to our handy dandy equation, we can see how that would happen and why that would happen. Okay, so I'm just going to zoom in here and just kind of zoom into the most recent area here. So basically what we see is our velocity drop off a cliff. And remember, the velocity wouldn't have dropped unless it dropped because they put all this money in. If they didn't put this money in, then the velocity wouldn't have dropped. And that's because we go to our equation. So now what's really happening is they're sitting there, the Fed and all their ilk are like, we need to print money. So this, now we've had new things. These stimmy checks are direct, actually increase in the money supply, right? So they're directly going from the government going out into the real economy. So that's something that's new that hasn't really happened before. But they're just increasing the money supply. So if you increase the money supply, but the prices don't go up that much, you know, we're not measuring a price increase. The prices aren't going up. Matter of fact, oh, maybe it's deflation. That's what the Feds complain about. Oh, we have deflation, right? And then the GDP, how is the economy doing? Well, we're in recession, so we have negative GDP. So if with this is dropping, the GDP is dropping, the prices are relatively stable, then, and you add trillions of dollars into here, what has to happen to make this equation balance? The velocity has to drop to make up for the money supply. So you can see here exactly what that is. And this sort of is why, although velocity has a real world, you can kind of thought experiment what it is, that which is fine. But you know, on the other hand, it's sort of a fudge factor. It's sort of a fudge factor to make this equation balance. But here is going back and connecting this together. So this is what's happened. They increased the money supply because they're like, oh gosh, we're closing down the economy and we have a disaster, right? We have all these people unemployed, just historic. I mean, this is worse than the Great Depression. It really is. I mean, they've just cooked the books to make it sound like it's not, but it's worse than the Great Depression. And the result is all that didn't do very much, and hence the velocity dropped. You know, and that's what we saw, because we saw that savings rate. We saw that savings rate increased a lot. We saw that people were their income increased a lot because of all the stimmy payments, and they've saved some of it. So that's good for them. But then here's the thing. So we're at this equation and velocity is dropping, but now we have to talk about inflation. If people are concerned about inflation, this is the one thing that the Fed struggles with, right? See, the Fed is losing the battle here. That's what this survey says. If the Fed was successful, see, the Fed is saying, look, we're going to have some increase in inflation, but it's going to be transitory, right? So they're saying long term, it's like, hey, look, there's not going to be inflation, so you don't have to worry about inflation. We're saying 2%, and yeah, it might go to 3%, even 4%, but it's only transitory. It's going to be just 2%. But they're advertising this, but yet most people are saying, screw you. 77% of the people are saying, I don't really believe you, right? They're saying, I don't believe you. And so now we have a really kind of a sticky wicket that the Fed is in. The Fed is marketing this. And what's really interesting too is I'm impressed that this younger generation isn't buying the Fed's garbage. Look at that. They're losing the battle. That's what that means. The Fed is saying, hey, there's no reason to be concerned about inflation, but 52% of the kids are out there saying, no, I'm concerned about inflation. So that means they're losing the battle. They're losing control. They're losing control of what? This equation. They're losing control of velocity. Now, why would that be? One of the things that you could do is you can look up on like Venezuela. There's some good documentaries. You can look, you know, I know a lot of people don't want to get into like conspiracy theory and all that, but you could go and there's like BBC has some, and some other mainstream media sources do have like documentaries where they just go talk to people there. And there's one there, this guy is like a scooter repair guy, and he owns a scooter repair, and he's just got piles of cash on this little table. You know, he's working in the street, and then piles of cash. And he's like, well, it isn't worth very much. Well, you know, that's an example of an inflation, and that's Venezuela is sort of hyperinflation. Hyperinflation is just where the price levels are changing very, very fast. Now, I'm not saying that we're in a position for that, but the thing is, if they lose control of velocity, then that can and will cause price inflation. Now, the other thing to understand is our GDP has been dropping, and just looking at it, even forgetting about GDP, just the quantity of goods are going down. So remember, you have your supply and demand curves, right? So if the supply, generally speaking, if the supply of something goes down, the price needs to go up to account for it, right? So it's really just the mechanism of this equation. So the point is that the cerveza has affected this guy here, the quantity of goods. So, we had like food factories closing, this, that. And right now we have a situation where there's a lot of people, there's sort of an incentive not to work. So generally in the overall economy, there's less stuff. So this is going down. At the same time, P is sort of holding, maybe it's starting to go up a little bit. And what is that doing? The right side's over here. And at the same time, they put a bunch of money. So therefore velocity has dropped. But now look at this equation. Now your money supply, they already increased it. It's already out there. They already put that $2-3 trillion out there, but it hasn't moved much. But now imagine that you have this big number here, and even a small increase in velocity could have a large effect on both the quantity and the price. Now, is the quantity going to go up? Well, it's not. It's not going up. It's not. Think about it. Like, even if the velocity goes up, how many more McDonald's are there going to be to buy that stuff? How many more car makers are going to be? Cars going to sold? Houses going to sell? Just not that much. There's a huge lag there in getting the quantity up. And especially that the quantity is down because of all the just disruptions with the cerveza sickness. So the point is, if this velocity picks up, because you have 77% of people are like concerned about inflation, then the prices are going to go up. It's a doom vortex loop. If velocity goes up, prices go up. Velocity up, prices up, and prices up causes the impression of more inflation that they're concerned about, which forces people to not want to hold cash and buy something with it. So this is a doom vortex right here. This is a doom vortex. Okay, AKA George Gammon. So going back to this is why this is such a hugely significant study. This is huge. And I kind of wonder, I don't know if the market will get a glimpse of this and start thinking about it, the stock market and the bond market. Because if the traders and the people out there in the bond and stock market got to be realizing that, like, the Fed's losing the battle here. The Fed has already lost the battle. Now the Fed has to get this down. The Fed, this report should come in, and this not concerned at all should be above 50%. And then you say, hey, the Fed's winning. Right now, the way it is, the Fed is just horribly failing. And the problem the Fed has is the Fed can say anything it wants to say, but people have to go to a store and buy something. And they can see what's going on there. They can see, hey, is the price going up? Or, hey, why is my groceries, let's buy the same groceries I bought last month, and like the price is $50 higher. It just goes on and on and on. And the problem is when the velocity kicks up, it just kind of gets out of control and it feeds on itself. So going back to some of the studies, like going back to some of like documentaries, if you look at the one like Venezuela and stuff like that, you have this scooter guy, and the scooter guy got this big pile of cash. And so what is he doing? He can see that the prices of things are going up. So for example, if he has to buy a part for a scooter and he knows, let's say he knows like, hey, I know that I usually have 5 alternator replacements on a scooters in a given week, right? So he's like, okay, so I know I'll leave 5 for them. Now, normally, let's say he would be like, if a guy comes in and needs an alternator, I'll just go buy the alternator then, right? But now the guy's going to be like, hey, look, every week and every day, matter of fact, I go to get the alternator and the price is going up and up and up. And then he's struggling because he's like, look, I'm struggling to tell, like I just told the guy I talked to yesterday that I charge him a billion bolivar or whatever. That's the wrong currency, a billion whatever, to fix his scooter. He's like, all right, well, I'll think about it. And now I can't do that. I got to raise it to 2 billion bolivar, or more like 1.2 million bolivar, whatever it is, because like my part's going up and it's just getting out of control. So now he might start pulling up demand. See how that pulls up demand? Because the person he talked to him a week ago, and he's like, it's a billion. And this week it's 1.2 billion. And the guy's thinking, oh my gosh, well, next week is going to be 1.3 billion or 1.5 billion. I better get it fixed now. So it pulls the demand. So now the velocity goes up. So now he buys the scooter repair. Now the scooter repair guy goes and says, okay, well, you know what? His same things happen to him. Oh, the part was a million Boulevard last week, and now it's a 1.1 million, 1.2. And the guy's like, oh, geez, you know what? Well, I'm going to go buy 5 of those right now. And so he goes to buy 5. So it just pulls up the demand and pulls up the velocity quickly. And what's really happening, it's a hot potato. It's that cash is a hot potato, because if you sit on that cash for 2 weeks in Venezuela, you lose the purchasing power. You lose the purchasing power. So if that scooter repair guy goes out and says, oh man, I got the cash now, I buy 5 of those parts now, then he gets the buying power. He gets the win, because he can go up and say, hey, look, you know, the scooter repair is going up every week a little bit, and maybe he can cut them a little deal, but he gets the delta because he doesn't have to pay the delta for the part, right? And so that's kind of the dynamic. It pulls demand forward, and it increases velocity. And so if that happens, and that can get out of control. So it's funny. It's when you looked at it over this last year, and I've looked over this for decades, and you're like, the Fed has just gotten away. The bond vigilantes have not shown up for decades and decades now, but they may be showing up now. So that's it for this one. I had heard about this on some other channels, and so they did a good discussion on it too, but I just figured I would give my take on it. So that's it for this one.